Welcome everyone to our third quarter market review. I am Jeff Elvander, Chief Investment Officer for RPAG. And let's look at the third quarter, which was negative, which was bad for both equity and fixed income markets, with negative returns across the board. And that was partially, if not completely, driven by the rise that we saw in long-term rates. And so we have a great chart at the end here that I'll run through that looks at that increase. But now we're at rates that we haven't seen in the last 15 years for the 10-year Treasury. And so what that translated into over the quarter, we saw fixed income markets, as rates rise, those prices drop. Fixed income was down a negative 3.2%, so really close to what equity markets experienced over the quarter at a negative 3.3 and 3.8 in the national markets. But the drop in fixed income brought those markets negative for the year. So now the broad U.S. fixed income markets are down 1.2% for the year. And in the equity markets, U.S. equity and international, we had some pretty spectacular run-ups in the first and second quarter. So both of those markets are still positive for the year. When you look at some of the statistics out there, economic statistics, unemployment did increase. It's now 3.8%. But that said, that still really represents a tight U.S. labor market. And when you look at some of the Fed's responses and what they've done, they did raise rates 25 basis points over the quarter. And they're still looking at the data. So certainly the unemployment figures are important. Their other bogey that they look at is inflation, and which has come down, certainly not anywhere near their 2% target rate. And so that they indicated at the last meeting that rates would likely be higher for longer, given that outlook. But certainly there's been some indication from the Fed that these longer term, the rise in these longer term rates, these long-term yields, may also help bring the economy or bring the inflation numbers down, and where they may not need to raise short-term rates. So we'll see in the coming months what the data comes in at and what they do. But I'll say again, a lot of what the Federal Reserve has done and what they've indicated has been a factor, I think, in where the long-term rates have gone. So let's take a quick look at the U.S. equity markets. And it was really interesting. We saw small cap value stocks be the best performing for the quarter, down only 3%, versus their counterparts, small cap growth, which were the worst performing stocks at a negative 7.3%. So small cap growth stocks, certainly like maybe the riskiest stocks in the U.S. equity market, did perform the worst. If you look at growth, certainly we've seen growth in the top right-hand chart. We've seen growth outperform value generally, as we've seen it this year go. And then if you look at sectors, depending on the strategies that are employed by the plan that you're using in the growth and value space, this is really how they laid out or how they fell over the quarter, with energy and telecom being the only two that posted positive returns. And not so surprising, the interest rate sensitive sectors, real estate, utilities, were the worst performing. Move to the international markets. A couple things to note here. The top right-hand chart looks at developed markets versus emerging markets. The developed markets continue to outperform emerging markets, which have really been hit hard by the rise in rates. That does not help those markets out. But most interestingly enough, if you look at the lower chart where we look at international versus domestic or U.S. markets, we did see earlier the international markets start to outperform. A lot of this was due to valuations, and they had some very attractive valuations versus the U.S. markets. But the U.S. markets have been very resilient. And you'll see here with the blue shaded chart there that the U.S. markets have come back even with those strong or very attractive valuations in the international markets. The U.S. market has been pretty resilient and strong, and has started to now outperform those markets, which really just outperform for a very small period of time. Let's look at some of the fixed income markets in a little greater detail here. I already mentioned the long-term rates, how they rose, and as those rates rise, that impacts fixed income to a pretty high extent because those prices drop. In addition to how they impact equity markets, you look at the top right left-hand chart, performance by maturity, you'll see the effect that those long-term rates had in the longer-term bonds, and those are the 10+ year bonds. And you'll see over the quarter that specific maturity category was down a negative 8.7% with that tick up in yields, which we'll look at, which is our chart of the quarter at the end here, which I'll cover. But a very big drop in performance for those longer term dated bonds. The yield curve is also interesting to look at. Really, the shape, it's still relatively flat. The Fed's been raising the short end. The long term, really just finally caught up, I think. But from where we were a year ago, not many changes. Still still a little inverted, but maybe flattening out a little more, which is not necessarily a bad thing. When you look at the sectors down below, of course, cash, which is really zero duration, was the best performing at 1.3%. So those are some of the details in the U.S. international fixed income markets. Here is our kaleidoscope, and we have seen the FANG stocks put some really good returns up over the first couple of quarters. And those are all of the large tech stocks: Facebook, Google, Apple, Netflix, and year to date, that asset class where all of those stocks reside is still the best performing, almost 25% year to date. So some very strong performance there. The inflationary asset classes such as commodities and global REITs are the worst performing and have given up the most after some pretty good performance in the last couple of years with the inflation numbers. And so really that I think is just with the higher inflation numbers going on for longer, those have come under a little pressure. As we finish up here at our chart of the quarter, I alluded to this. This chart here reflects long-term rates and where they are at today, but where they have been historically. And you'll see this chart goes all the way back to the 50s and 60s. We saw rates, really generally been increasing all the way up until the late 70s, early 80s, where they peaked, and then really have been coming down ever since. You'll see where the latest move was higher, and now where that puts rates at as of September 30th, 2023. The long-term rate is at 4.57. That's the nominal yield. After you subtract inflation, that's what represents the real yield, which is now positive. And we had seen in the past that was negative with the loose monetary policy that was happening, brought those negative for a time, but now both are positive. And again, as rates increase, that doesn't only put pressure on the fixed income markets, but the equity markets. And if they do go higher, then I think we can see some more pressures in both of those markets in terms of total return. Again, not, when you look back, we were the last time we were at these rate levels were back over 15 years ago. But certainly still lower than some of these historical averages when you look at those. And so if we get closer again to those levels, there could be some more pressures in both of those equity and fixed income markets. So this was the theme over the quarter. Thank you everyone for joining this market review. See you next time.